Well, thank you very much, Paul. It is always a great pleasure to come here to Pittsburgh. It's a beautiful facility here. And these are interesting times, are they not? And people have been remarkably interested in housing markets here of late. And so I don't attribute that to me. You should have at your desks, at your tables there, copies of our Crawford County Housing Outlook. And so encourage you to look at those. Have to give a big thanks to Security First Title. They sponsored all of most of our county housing outlooks, including the Crawford County Housing Outlook. Did one new this year. We have Cherokee County, and so if you're interested in Cherokee County, then look on our website and talk to the Security First office. They could get you copies of those. And then I have to also thank the partnerships that we have with realtor boards across the state. Kansas Association of Realtors, we prepare the monthly MLS statistical reports for all of the local realtor boards. Kansas City Regional Association of Realtors is a part of that partnership, and now the Pittsburgh area is a part of that board. And so it's because of that that we're able to have the data that we need to do the work that we do. So Jeremy talked a little bit about his employment forecast and the things that we have going on in the labor market. When I look and do our annual housing forecast, I also look at mortgage markets and what's happening there. And of course, what's happening there has been crazy. We have seen mortgage rates go up more than double over the course of this year. And I think the latest figure that I saw last week was 6.66%, which somehow sounds especially ominous, doesn't it? And so the question is not where are mortgage interest rates today, but where will they go going forward? And the Mortgage Bankers Association monthly updates their forecast. And last month, they increased their forecast, the rate that they expect mortgage rates will go to by the end of next year. They had said 4.8%, they're now saying 5%. So either way, one of the things you want to take away from this is that financial markets across many different dimensions do seem to be behaving as if they expect longer-term interest rates to come down in the coming months. And that, I think, is consistent with the view that the Fed would bring inflation under control. Whether that is through a crash landing or a soft landing is a different question. But that inflation, financial markets right now seem to be suggesting that inflation will not become embedded into the economy. And we can have a larger discussion of why that's the case and so forth. But I want to get to our panelists, so I'll talk really briefly about some things we're seeing in Crawford County and Southeast Kansas. These numbers here are home sales activity for 3 counties here in kind of the broader Southeast Kansas. I tried to pick areas where there's a micropolitan area, a central city that's at least 10,000. But Crawford County is the blue line that we have up there. And I've tried to give a little bit of a longer perspective. And you can see that over the last 7-10 years, we've seen some steady increase in home sales activity. These are the moving averages for each month. It smooths out some of the changes that we've seen. Home sales have seemed to drop off in Southeast Kansas over the last few months. That's true across the state. But the thing that I really want to focus on is that while increases in interest rates and other factors in the economy certainly have tapered demand, the real story in housing markets across the state is supply. This is a measure of discount from the original asking price. So we all know you go to buy a house and they may be asking, say, $150,000 for this house. And then you work with your realtor and you make an offer, and often you make an offer that is below the asking price. Well, historically in Southeast Kansas, about 80% of the homes that have sold with sale prices that are lower than the original asking price. Again, that's normal. That's just part of a healthy negotiation process that we have. You can see the darker blue line on the bottom is Kansas. And over the last many years, that number had been going down from around 80% of homes selling at a discount to only about 60% of homes selling at a discount prior to the onset of the pandemic. But after the pandemic, that number plummeted across the state, everywhere. And you may have actually seen some reports saying that number's going up, housing markets are falling apart. Well, again, Kansas, which is pretty close to a national number there, it's tipping up just a little bit, but it's down around only 40% of homes that are selling at a discount from the original asking price. That means that 60% of homes are selling at the original asking price or above, okay? That's an incredibly aggressive seller's market that we're reflecting there. And you can see that similar pattern happened across all of Southeast Kansas over the course of the last 2 years. Another way that we can look at that is a measure that we call months supply. We take the number of homes that are actively available for sale and divide it by the average pace of sales over the past year. And so we normally think of a balanced market as being one where we have between a 4 and 6 month supply. You can't see on my slide up there very easily, but there's actually a shaded region between 4 and 6. Above a 6 month supply, we often think of that as being an indicator of a buyer's market. It tends to favor buyers. Below a 4 month supply, we tend to think that it favors sellers. Well, in Kansas, we've been below a 4 month supply ever since 2015. And at the bottom here earlier this year, we got to a place where we had about a 0.6 month supply on average across the entire state. Incredibly tight market. So is that coming up? Yes, that's coming up just a little bit right now. Some of that's seasonal, but even if it comes up, it's still well within that range of a very, very strong seller's market. What's happened in Southeast Kansas? Again, you can see for Crawford County, for Labette County, Montgomery County, traditionally, month supply is much higher in Southeast Kansas. It's actually one of the highest figures in any part of the state. That's just been a normal part of housing markets here for a long time. But since 2019, that has just really, really dropped. And again, what's been going on? Well, remember when we first went into the pandemic and there was a concern that we were going to have some falling back of demand. We were already in a world where housing markets were incredibly tight. We did not have enough inventory for all of the potential buyers that were out there. And I kept asking realtors, how do you keep finding homes to sell if everything is so tight? And they were very creative, and home sales continued to increase. Well, when the pandemic hit and the shutdowns happened, we thought that's going to soften demand. It turned out that that was not the case. And I think that was true for several reasons. Number one, the people who are most likely to be home buyers as opposed to renters are people who were least likely to lose their jobs due to the shutdowns. They could pivot and work from home and do things like that. At the same time, everybody got the checks from the federal government and the stimulus payments. Number three, we got all this extra money, but we couldn't go out and spend it. We couldn't go out to eat. We couldn't travel. And so people were paying down debt. People were flush with their savings accounts, so they had lots of money. Number four, they were sitting around looking at the same four walls a lot more closely than they had been in recent years and thinking, I'm getting tired of this. Some of it might have been, I want a work from home office or things, but a lot of it was just, I want something different. And then fifth, mortgage rates as a policy response to the pandemic dropped down to the lowest levels we've ever seen in history. And those five factors came together to really, really juice up demand in the housing market. And that's something that normally housing markets are incredibly local. You know, what happens in Hayes doesn't really reflect what's going on in Pittsburgh, right? But these are factors that really were nationally broad-based factors that affected markets all over the country. And so as a result, we saw this incredible increase in demand, but it was at a time when, go back to 2020 here, we were already with a shortage of homes available for sale. And so as a result, we've seen some sharp increases in home price appreciation. This is just the median sale price, and you can see Crawford County median sale price gone up from around, say, $80,000, $85,000 prior to the onset of the pandemic, up to about $120,000, $122,000 more recently. That's a really, really sharp increase in median sale price. Now, some of that can be composition, but statewide, we've seen home price appreciation over the first half of this year over 17%. Normally, Kansas home price appreciation ranges between, say, 4 and 6%, and we'd say 6% was really strong appreciation in Kansas. So this has been just absolutely stunning, and it has been that perfect storm of tight inventories, in a sense, kindling that we'd been laying down for about 15 years of not having enough housing. And then we hit a blowtorch to it with the stimulus that was provided following the pandemic, and that has caused a forest fire in the housing market. And that's cooling right now. But the takeaway that I have with our housing forecast is that while home sales activity we think is going to decline across the state this year and then remain a little bit of a rebound, but mostly flat next year, the home price appreciation, even as that demand tapers off, home price appreciation is only going to slow down to what we would ordinarily consider a really strong, healthy number. Our forecast for this year across state on average is a 12.3% increase in home prices. That's down from where we were earlier this year. Next year, we're forecasting 5.5%. Again, ordinarily, we would say that's a really, really strong home price appreciation number. And the only reason that we somehow feel like the sky may be falling is because we came from a place where it was just so astronomical to begin with. And so I still see a seller's market going forward, even if it's much less tight. Now that's what I see. You can see all of our housing forecasts. You can see my slides that I have here on the Center for Real Estate website, realestate.wichita.edu. But, you know, my dad always used to say, those who can do and those who can't teach. And so we felt it would be a lot better to have some doers come up and talk and share what's going on in the housing market. And so we've put together what I think is a really tremendous panel of some local real estate experts. And I'd like to invite all three of you to come on up now. First, we have Shelly Hildebrandt. Shelly is a real estate agent and associate broker with Cobb Realty in Pittsburgh. She's been licensed for 20 years and has been a top producer in the area over most of that time. She's lived in Southeast Kansas her entire life, and she loves the changes that she's seen in the community over those years. She's a current chapter director for the Pittsburgh chapter of the Kansas City Regional Association of Realtors and has served as president of the Pittsburgh board 3 times. She strives to keep up with current housing trends and is knowledgeable about housing market values. She does this because she is passionate about serving her buyers and sellers and helping them complete their transaction. She enjoys meeting new people, helping them find a home that's perfect for them. In addition to being an outstanding realtor, Shelly lives on a farm. She has 3 grown children, 9 grandchildren. She enjoys gardening, traveling, horseback riding, and she's an avid fly fisher. Please join me in welcoming Shelly Hildebrandt. We have another fantastic real estate professional, Tony Sanchez. Tony's an agent with ReeceNichols Sunflower Realty Group here in Pittsburgh. He's been serving Southeast Kansas realty needs since 1999. In 2010, Tony was named Realtor of the Year by the Pittsburgh Board of Realtors. He's a proud husband, a father of 2 beautiful, bright kids. He's active in the community, belonging to a number of different civic organizations. And I just learned as I was creeping on him last night that he also is actively involved in Pittsburgh Community Theater. And I would love to come down and see a show that you're in sometime.
Well, you're in luck. We have one this weekend.
Very good. Excellent. And finally, we have Carrie Martin. She's a senior mortgage loan officer with Fleet Branch Home Loans. She's worked in the finance industry since 2004 and has been back doing mortgages since 2016. Carrie says she loves helping buyers find solutions to their financing needs. She said, when a mortgage helps a family and a community accomplish in the long run, what that does is a beautiful thing. And I think that's very, very well said. So please join me in welcoming both Tony and Carrie. Well, as I said, I sent some questions to them in advance to think about, and as home sales, I mentioned that home sales have fallen in Crawford County here over the last few months. So one question I have for you is, how much of this decline in home sales activity do you think has been a function of softening demand versus a lack of inventory? How does that balance fit out? And we'll start with you, Shelly.
Primarily, it seems to be, up to the first and second quarter, more of an inventory issue. It's still an inventory issue, but now people are, kind of trying to second guess what the interest rates are going to do. So I think there's a combination of that at this point. Mm-hmm. I still have a long list of people that would still buy if there was inventory. Mm-hmm. And we just are really lacking in that, and it's very difficult to, try to just come up with more properties for them to see.
So even with the declining demand, you still have a backlog of potential buyers if they could only find what they wanted. So, Tony, what are you experiencing?
If I had to put it into percentages, I'd say about 70% inventory and about 30% interest rates. I think that while interest rates make people nervous, we still have a very strong need and a lot of buyers still looking. One of the things that we do in our business is we monitor our hits on our websites and how things are, trending. And when you see those hits still, in the 500s, in the 600s on certain properties, you know that, okay, there's still a lot of buyers out there looking. I'm so glad to be on this panel with people of experience. Shelly and I started just about the same time. And to be able to have this perspective in our careers right now is a wonderful thing, because for years, it was, okay, July 15th happened, and now it's gonna start slowing down. Families are thinking about schools, what they're going to be doing along those lines, and then it slows way down, and then, about mid-September it starts to pick up again, and then we have a gradual increase until about January. And the reason I say that is because, Pittsburgh only has about a 3% growth rate. I'm interested to see, and I was just talking with Michael Davidson earlier about this, as to where our growth rate's gonna end up for this year. So it'll be really interesting to see, but mostly we have people, doing lateral moves or either up or down in our community, and so we don't see a lot of change. And then all of this happened, and we started seeing, okay, well, we are not slowing down, and it is November and we are not slowing down. And for 2 years, we did not slow down. We just kept right on going, right on chugging along, and just moving. And so I noticed that one of the things that we did was in September, we had an average sales price for new and existing homes combined of $132,000. And we need those homes. That's the homes that we're looking for. I know 80 to 150, we need homes.
We had
Yeah, go ahead.
50 of them.
Yeah, we need more of those homes.
Yes.
So the demand is still there. We have a lot of buyers who got beat out because they didn't have the cash or the conventional loan. So we've got first-time home buyers, USDA, FHA, veterans are all still really looking because nobody was interested in doing that when we had a cash or a conventional loan ready to close in 25 days. So it's interesting.
Well, Carrie, you see the buyers a little bit earlier sometimes, at least in the past. If they didn't talk to you first, the homes were sold before. How are you seeing buyers, especially with the rise in mortgage rates? How is that affecting what you're seeing with some of the buyers you're working with?
I feel like we refinanced half of everyone in 2021. And that was probably the biggest mistake that we ever did. Just because those people that have been in their house for however many years, maybe they were paying 4%, 5%, 6.5% doesn't seem so daunting. But I was one of those people that refinanced down to 2.5%. So now if I go and I try to re-enter the market and I'm looking at 6.5%, my purchase price or purchasing potential is drastically different from what it was at 2.5%. So I feel like I'm probably the opposite of you, Tony, and I'm probably going to say 70% of the rates. And it's just been this year that I've seen it drastically. Like May is really whenever our interest rates started to go up. And it's come down and it's just been since those rates have been going up. And we adjusted to 5.5, but then they hit us with 6.5, and it's kind of hard to readjust.
Well, last year at this time, you asked the question, where do we think the market's heading? And I said, if rates go above 6%, we're going to see some real change. But if they stay under 6%, we won't. It will still keep driving. And I agree. As soon as they hit 6%, then the Fed accomplished what it set out to do, which was to curb the housing market in an attempt to curb inflation, which I guess time will tell if that actually plays out. But yeah, so I mean, I think that held true.
So, Carrie, you said that you're seeing a pretty significant softening in demand, but how much of that is so you see both purchase money mortgages, people buying for a house, but you also see refinancing. I'm assuming refinancings have just disappeared. So when you're saying that maybe 60%, 70% is due to demand, you're talking about the purchase side of the market.
I am.
Okay, very good. Well, based on the month supplies figures, that I showed, we are still very much in a seller's market. But, as much as we economists want our statistics to mean things for people's behavior, they don't always act the way we wish they would. And so my question for all of you is, do you see buyers now that we're sort of settling in where we are this fall, are you seeing buyers and sellers still acting like it's a seller's market? Are they acting more like it's a balanced market, or are they beginning to act like it's a buyer's market? How are they behaving? Shelly?
It's still somewhat a seller's market, just due to the fact that the seller has the advantage of there's not much inventory. So the sellers seem to be just a little more hesitant to, negotiate down very much. And the buyers kind of know that, but it just depends on what the buyer's reason is for their move.
Okay.
If they have to move, they're still thinking, okay, well, this house may not be on the market next week if we don't pounce on it, if it's the only house out there. For instance, in some of the smaller communities, if they want to be in Girard or different areas. So the sellers still have the advantage somewhat. And then what's ironic is some of the, I say older buyers, my age, they knew back in 2006 to 2008, the rates were 5-6% back then. So they aren't necessarily seeing that 5 or 6% is horrific. It's not, obviously they'd rather have lower, but it's like, well, it's still not scary terrible. It goes up much more and we might be more reluctant. So it just depends on the reason for moving. It depends on, to me, the age of the buyer, the buying power of the buyer. And again, I agree with Carrie and Tony. the people that are getting USDA loans, they don't have a down payment, they're getting FHA loans, they're getting seller paid closing costs, and they have to add that on top of the offer. They're borrowing all of it, so they're starting out with zero equity and don't know which direction they're gonna be going from there. So it's educating your buyer, there's been some cases where I've said, you know what, it might be a good time to just wait. You have a roof over your head now, just sit back and coast for a little while and see, if you sense that they're afraid, we don't want them to buy afraid. We don't want them to feel like they bought a house and they were pressured into buying a house. Give them all the facts and let them make a good decision based on that.
Very good, very good. Tony?
So I'm lucky in that I have a house on the market right now that kind of fits this whole scenario. So I had a guy who, he does work through the winter. He owns a swimming pool business, and he keeps his guys busy through the winter, fixing up a house and then putting it on the market. And so I had sold him a house in the early fall of 2022. And I said, now I need you to have this house ready and on the market by February, and we'll be able to get you top dollar, which for a renovated house in this market was around $135 a square foot. So we were looking at a $310,000 price range. So it was super exciting. I was excited, but then he lagged and he lagged. And I'm thinking, you're missing your window, and I'm shooting him text and I'm saying, you're missing your window. Let's get on this. What are we doing? How are we going? How's it going? Finally, he gets it on the market late June. We're at $310,000 still, because it could still happen. The appraisals are there to support the $135 a square foot. So, but the interest rates had increased. The market had changed substantially. So now we're sitting here and I'm going, okay, and we're having some activity, but not anywhere what it should be. And so instantly I'm like, we gotta lower. He realizes it. We go down to 295. We go down to 290. We get it under contract for 282.5. Okay? So you can see the percentage that it's dropped just in seller expectation versus market.
So you're really talking about the upper end of the market there
Right.
with that.
Right.
Let me ask you this question. If he'd gotten it available and you'd listed it on March 1st, what do you think his situation would have been in terms of the buying,
March 1st, he may have been looking at multiple offers, and they would have all been above asking.
So it changed pretty dramatically, at least to that upper end. Are you still seeing multiple offer situations? So you talked about the sweet spot. You said, man, we could use homes at 130. You have a nice home that comes in at 130 in a good location and so forth. Are you still going to see multiple offer situations quickly with that?
I think we could. It will be not unexpected if it did happen, but I would think it's becoming rarer and rarer.
Most likely.
Yeah, most likely. I mean,
I
because...
said less likely.
Oh, less likely,
Less
yeah.
likely, because,
Yeah.
I mean, to me, I
It's-
feel like it's
it's-
getting less and less likely all the time.
Right. So basically on that $282,000 price point, it's okay, at 6.1%, this is how much my buyer can afford versus at the 2.9, 3.5 interest rates that we were at.
Mm-hmm. Well, one of the ways that we can, deal with the lack of inventory is by building new homes. And so what can you tell me about projects in the Pittsburgh area for new home construction? Where are those at? What price points are they at? And what do you see going forward in terms of providing new homes in the Pittsburgh area? And I'll open that to any of you that want to share what projects you're aware of.
We've got some housing additions going up.
Which
they're
additions?
not getting finished as much as, as fast as we would like, and some of that is because of supplies.
What price points are those at?
I'd say they're between,
70 and up.
yeah, I mean, most of them are right around 225 to 265 for the new construction. But, it's interesting because we've got that new retirement community that's going up here in town, which is, there's 29 homes total going in out there off of 4th Street, and we have 24 built. so far. I've already seen, and I'm sure you have too, people who have sold their home to move into that situation, which is basically, a really nice retirement situation for folks where they've got the extra
Maintenance
storage
provided.
building, maintenance provided, yeah, all of those things. So that's going to be interesting to see how that continues to affect our market. I don't know how many of those are sold out there, and I should, but I apologize, I don't. And then we've got
12 or 13 maybe.
we've got a new Sunflower Estates subdivision going in where their first phase will be 12 new homes. Their sewer is going in at the end of October out there. That's on Home and 20th here in Pittsburgh. And then we have the Creekside subdivision, which is the, I call them styrofoam homes, but they're stress panel homes.
Behind the high school.
Behind the high school. Those are great homes, and they've got plenty of room to build a lot more out in there. And those are selling around $265,000, all said and done. So.
But nothing in that more sweet spot that you wish you had more of.
Right, we could use it. I don't know that builders can build them in our area for that.
Very difficult.
Very
Yeah.
difficult.
That's construction costs have been, construction costs have continued to rise. Labor issues continue to be an ongoing issue, and it makes it really, really difficult to build anything other than things that are more at the top end of the market.
We have had a few builders that have been buying some of the land bank lots and building some of those smaller, more affordable homes in those areas, and that's been good for the neighborhoods. It's build a nice house in a median neighborhood, and is in a price range that's typically pretty affordable. So those have been good.
Carrie, what are you seeing with the new home construction side? I assume you do construction loans as well at with your company, and so what are you seeing in terms of the new home market?
As far as like price per square foot, it's kind of leveling off because it was going straight up. But for a while, I feel like new construction in an older home, price per square foot was about the same. And there needed to be a difference in there for builders, for investors overall, just to reinvest into the communities. So now we're starting to see that spread a little bit more, so that's good.
Very good, very good. Well, I mentioned earlier that the Mortgage Bankers Association is forecasting that mortgage rates will actually fall next year, down from the mid-sixes, down to 5%. If they are correct, what do you see that doing to the local housing market? I'll start with you, Carrie.
I think that we're going to see an influx of buyers. Like Shelly said, there's a lot of people on the sidelines right now because so my average loan size is about $146,000. $146,000 payment for Kansas last year was $870.50. $146,000 payment today is $1,188.27. So that's a $317 spread. And $317 isn't so bad if you look at it isolated by itself, but with the increase in gas and groceries and everything, I think buyers
And property taxes.
more conscious about what they're doing, and what I'm seeing is like the houses that take longer to drive into town to work, their commute's gonna be longer with those houses. There's more negotiations going on with those price points and those sales than what we've seen in the past. So there will be an influx in buyers, definitely.
Tony, last year you said as long as rates stay below 6%, you'll be okay. So if rates go down to 5%, what's your crystal ball say for next year?
I think we're going to have a lot of sellers who are on the fence and saying, okay, well, now's our chance, because I don't think we're going to see much of a difference in terms of what they can get. And that's managing expectations as well on our end. But so I think that we'll see some sellers get off the fence, and of course the buyers will be there. They're there now.
Very good. Shelly?
My glass is always half full. And I still think, just from past experience, people are always moving for all kinds of different reasons. Rent is going up, so in some cases, people want to buy because at least their money's going towards something, and they can still buy cheaper than renting. So you've always got that element. I think if interest rates go down, I think people will be confident again. It's like, okay, so this is a move in the right direction. I think we'll still have people that are just waiting for that to go down a little bit and go, okay, well, at 5%, this is what we can do, and just really have an idea of what their payment would be, and be able to move forward if they're wanting to buy.
Yeah. Well, you all have brought up something a little bit, and Carrie, I think you mentioned it, that issue of, one concern I've heard people ask, and I'm going off script here, so beware, this is a question I didn't ask you, about lock-in. People who have the 3% mortgage, and maybe they would be a move-up buyer, but man, they don't want to give up that 3% rate. And so if they've got to move up even to 5%, that's a big increase. How much do you perceive that lock-in is going to limit demand as we go forward in the coming months, but even years? So Tony, you want to jump in on that? And Carrie, I'll let you follow up.
Okay, so our CEO over at ReeceNichols just went and had a big conference and sent down some notes to us. And one of the things that he highlighted was that the average American has $185,000 of equity in their home. So I'll just use myself as an example. So that would be true in my case. I bought my home for $139,000, sitting at 2.9% interest. Do I want to sell that home for $250,000, $300,000, or close to $300,000? So it just depends on where they are in their lives, like Shelly was saying, where they are in their lives. Because if they're at a point where they're ready to downsize, I'm 54, not quite ready to downsize yet, don't know how many grandkids I'm gonna have, all of that kind of thing. So, you don't know. So I'm still kind of wanting to stay where I'm at. But if you're 63, yeah, you might want to get that equity out of there, especially once they come back down, if they do come back down.
Very good. Carrie?
I think it depends on what type of house they have. If it was their entry-level house, it's 2.5% to 3.5% interest. That is a great house to turn into an investment property, and you exit that house and buy a new house and utilize that appreciation that you've gathered over the last 2, 3, 4, 5 years and pull it out and put it down on the new house. So it does kind of depend on, like Shelly and Tony were saying, what's their goal? Because eventually I want to live at the beach. And I'm going to take all my equity and buy that beach house, and I don't care what the interest rate is. So it just really depends.
Or the hurricanes.
Excellent, excellent. Well, thank you all very much. Tony, I have one last question for you.
Oh boy.
What is the show this weekend? Make your plug so everybody will go.
The show is called The Theory of Relativity. It's Friday night, Saturday matinee, Saturday evening, and Sunday matinee. And it is a wonderful show about that age between 18 and 23 when you're trying to figure life out.
So, excellent. So all go out to
Pittsburgh Memorial Auditorium.
Pittsburgh Memorial Auditorium and enjoy that. Please join me in thanking all of our panelists.